How many of you hate to pay taxes? All of you, right? Me too. Although most investments are taxable, there are quite a few tax saving and tax-free investment options which many investors are not aware about. Therefore, I have decided to put together a series of videos about tax-free and tax-saving investments. Today, we are going to discuss about tax-free bonds and tax-saving bonds. Before start though, if you are new to our channel, please consider subscribing to get notified whenever we upload a new investment related video. So let's get started. So, what is a bond? Bond is a debt financing instrument used by organizations to raise money from individual investors. If you want to know more about bonds and their types, please check our video about bonds and debentures, whose link is right here and also in the description below. Are tax saving bonds same as tax-free bonds? Short answer is no. There is a huge amount of confusion about tax-free bonds and tax-saving bonds. So let me explain. In case of tax-free bonds, there is no income tax exemption on the amount invested in those bonds, but the interest that you get from those bonds is tax-free under Section 10 of IT Act. Contrastingly, in case of tax-saving bonds, there is tax exemption on the amount you invested in those bonds under Section 54 EC or 80 CCF as per IT Act, but the interest earned is taxable. So, let's talk about tax-free bonds first. These bonds are issued by PSUs like National Highway Authority of India, NHAI, Housing and Urban Development Corporation, HUDCO, Power Finance Corporation, PFC, Rural Electrification Corporation, REC, or Indian Railway Finance Corporation, IRFC. Usually, tenure of these bonds is 10 to 20 years with return of around 7 to 9%. These bonds are considered safe investment options, with most of them having AAA credit ratings. So, how can you purchase tax-free bonds? If you are purchasing tax-free bonds at the time of issue, you can purchase them both online or offline through authorized brokers or authorized large commercial banks. If you are purchasing them after issue date, you can buy them on secondary market through your trading account. Keep in mind that the price is usually higher compared to face value when you purchase them on secondary market, which would reduce your return. So, what are the things you should check before investing in tax-free bonds? First thing is the redemption date and redemption value. Even though tax-free bonds are traded on secondary market, they are not as liquid as stocks. So, it is important to check the redemption value to get an estimate of your actual returns and the redemption date to get an estimate of your lock-in period. Depending on your purchase price, your returns can be lower than coupon rate. Hence, you should also check yield to maturity, that is YTM, to get an estimate of your actual returns, as it takes into consideration redemption value, redemption time, and coupon rate to give you an accurate estimate of your returns. Now let's talk about tax saving bonds. There are two types of tax saving bonds: infrastructure bonds and capital gains bond. You can deduct maximum of 20,000 rupees from your taxable income by investing that amount in infrastructure bonds under Section 80 CCF. Although Section 80 CCF is a subsection of Section 80C, this exemption is over and above the 1.5 lakh exempted under Section 80C. These bonds are issued by infrastructure companies approved by government, such as IFCI Limited, L&T Infrastructure, Infrastructure Development Finance Company, etc. So, how can you purchase infrastructure bonds? You can purchase infrastructure bonds in the same way as tax-free bonds, either through an authorized broker or bank at the time of issue, or on secondary market through your trader after the issue. you can apply for these bonds both as an individual investor or as HUF. So, what are the things you should check before investing in infrastructure bonds? You should check YTM, redemption value, and redemption date, just like tax-free bonds, as these bonds are also usually traded at a higher price than face value on secondary market. Additionally, you should also check credit ratings, as some of the infrastructure bonds issued especially by private companies do have a poorer rating compared to tax-free bonds. Now let's talk about capital gains bond. In case you recently sold a real estate property and you do not want to invest that money in another real estate property, you can invest that amount in capital gains bond. Long-term capital gains from real estate investments of up to 50 lakhs are exempt from capital gains tax if reinvested in capital gains bonds within 6 months under Section 54 EC of IT Act. These bonds currently yield 5% return. These bonds are issued by 4 PSUs only: NHAI, REC, PFC and IRFC. So, how can you purchase capital gains bonds? These bonds can only be purchased through authorized brokers or authorized banks by submitting an application. The detailed list of authorized banks through which you can purchase capital gains bonds is in the description below. So, what are the things you should know before investing in capital gains bonds? These bonds are non-transferable, which means that you cannot transfer these bonds on anyone's name or trade them on secondary market. Also, early withdrawal is not allowed under any circumstances. Even in the case of death of the bond holder, the nominee or legal heir has to hold the bond till redemption date. No cumulative interest option is available. Interest is paid annually, which is taxable according to your tax bracket. Also, you cannot take any loan against capital gains bond. If you like this video, smash that like button and share the video with your friends and family. Thank you.